Rich Bernstein is CEO and Chief Investment Officer at Richard Bernstein Advisors. So what is the message of the market here? Rich, welcome.
So, Kelly, I think that we were in a period several months ago where the consensus was that the economy was weakening. Some people thought we were on the verge of recession. And I think the Fed responded to that overall feeling. And I think their own research kind of showed that as well. However, the reality was that the economy was pretty healthy. And more importantly, financial conditions had not tightened, right? I think everybody forgets the central bank. The Fed is the central bank. Keyword is bank. And the way they implement monetary policy is through the banking system. They should be cutting interest rates when the banking system is slowing down and in some cases even problems. That was not to be seen, right? Credit conditions were still very, very generous, to say the least.
Should they then continue to cut rates from here or no?
Well, should. The Fed chair isn't calling me up, Kelly, and asking my opinion, nor should he. Don't misunderstand what I'm saying. But so I don't think what they should do is important. What are they going to do? I think they are going to continue to cut rates, probably not as fast as everybody anticipated several months ago. But the important thing to remember here is that they are cutting rates into an accelerating profit cycle. That is very rare. Normally, they would be hiking rates into an accelerating profit cycle. Why? Because profits drive employment. Profits drive CapEx investment. And so the economy, you get the multiplier effects from the corporate sector tend to stimulate the economy. This time, you're going to get that. Plus, you're going to have the Fed cutting rates, which I don't think it gets much better than that for the economy.
And so I know you guys have been talking about this bias towards small caps. So it's funny because you've been dead right about kind of what's happening with the markets overall. But is small cap still an area where you feel maximum confidence?
Yeah, absolutely. I think, if you believe that the Fed is going to continue to cut rates, if you believe that profitability is going to continue to rev up, you want companies that have immense operating leverage. In other words, deep cyclicality is really what that means. And that would be, things like energy, materials, industrials, mid-cap and small cap especially. Remember, mid-cap and small cap companies, almost by definition, are more cyclical than larger cap, higher quality companies, which tend to be more stable and don't even cause a cycle.
But the problem I wonder about with that is that when the Russell 2000 made no money for 3 years because of high interest rates, well, now you've got high interest rates again. So it'd be one thing to own them because you like the cycle, but it's another thing to own them if they're also going to be dealing with expensive borrowing costs.
Absolutely. Kelly, what you're referring to is the ever-present argument about financial leverage versus operating leverage. That happens in every cycle, right? Why do cyclicals outperform when long-term interest rates are going up? That is traditionally what would happen if if the nominal economy is accelerating, we would expect interest rates to go up. But cyclicals are more sensitive to the nominal economy. That's the operating side. So you always have this tug of war going on between the financial leverage, which might not help them as interest rates go up, but the operating leverage, which does help them because the nominal economy is getting stronger. History says the operating leverage wins.
Let's hope so, because these are higher levels than we've had for quite some time. And I even wonder about things like private equity. I mean, all these different areas where we thought we were going to get relief from lower rates, and we're not getting that. I mean, do you have any other tactical plays, even in the S&P 500, names, sectors, and the likes, that given what you think is likely to now play out for the next few months, which is they keep cutting, markets keep partying, basically, and hopefully the expansion keeps doing well, where else does that point you to?
Well, Kelly, if you look at asset allocation, your opportunities are pretty limited right now. The fixed income markets have been sniffing this out for a while, right? Everybody knows credit spreads are very narrow. That was one of the things that the Fed seems to have ignored. The credit spreads were very narrow. So the credit markets have been telling you that corporate cash flows are going to be stronger than people thought. So I think you're now limited to the equity market. There aren't many places to go. And in our portfolios, we'd rather get that operating leverage, cyclical side of the economy through the equity market than through junk bonds or lower quality credits or something like that. So that's why we're overweight all these cyclical sectors. I think it's difficult to say, like, we should go and look at other asset classes or things like that, simply because there is so much liquidity around. Financial conditions have been very beneficial. And so the opportunity set outside of traditional equities like small caps is pretty limited.